The boroughs are New York City. The burbs are everywhere else. Real estate is the ultimate game of risk and reward. It's the biggest investment most people ever make. Fortunes are made over a lifetime and lost in a day. And we're not playing with monopoly money. How do you stay ahead? Who's buying? Who's selling? And why? What do they know? We want the truth. You need an edge. Boroughs and Burbs is your secret weapon, giving you the insider knowledge and strategies you need to succeed in the high-stakes world of real estate. From Palm Beach to Palm Springs, Manhattan to Malibu, we press the experts to expose the pain, find the deals, and occasionally predict the future. That's Boroughs and Burbs, Thursdays, 3 o'clock Eastern, noon Pacific. Because everyone can make money in real estate.
Welcome, everybody. Boroughs and Burbs, number 181, mobile homes and parking lots. I got that wrong a little while ago, and I said mobile homes and trailer parks, and I was immediately corrected by our guest, an expert in the subject. So that's probably going to be one of our first questions. But before we begin, I want to thank our sponsor. So thank you, Grace Farms. You'll find them at gracefarms.org. We love you, Grace Farms. You can go to Grace Farms, enjoy the 80-acre campus, the river building, and you can have their specialty teas and coffees, and you can give them as gifts to your clients. We are boroughsandburbs.com, and you can find all the past episodes there. I want to thank my co-host, Roberto. I checked out your market report from a month ago, and it said, my colleague said you sold us out. Very provocative. And then I noticed that this month it's buy. You have 1 year to buy, and here's why. So if you want to know the answer to that, you're going to have to go to robertocabrera.com and check out the current market report. That's me. You'll find me at theengelteam.com. I'm John Engel in New Canaan, Connecticut. This is my weekly column. This week, I say it's not a rally, it's a relocation. And I think I quote Roberto's optimism, his sunny optimism on the New York market in there. And then I say why Roberto's wrong. So you're definitely going to want to connect to that. And with that, this is Kevin Bupp, our special guest. Welcome, Kevin. How are you doing? Where are you calling in from today?
Well, John, Roberto, first and foremost, thanks for having me. Excited to be here. I am speaking with you from the Tampa Bay area. Lived here with my family for the last 23 years now. So warm and sunny Tampa Bay.
Why Tampa Bay? Is that a place where you need to be to do your business, or does your business exist everywhere?
That's a great question. I mean, today our business exists everywhere, but to answer that question better, it's you got to go backwards to the age of 22. I grew up in Pennsylvania, Harrisburg, Pennsylvania, to be more specific, central Pennsylvania. It is the capital for those that don't know. A lot of folks think Philadelphia is the capital, but Harrisburg is. But there's not much going on there as far as the capital city is concerned. And so for that reason, I wanted to move to a more progressive city. I wanted to move to somewhere where there was sunshine, 11, 12 months out of the year. Even growing up in the cold, I never got used to it. Never got used to those 6 months of gray skies, getting dark at 4:30, 5 p.m. in the evenings. It drove me crazy. And so when the time was right, I had a couple years of real estate investment experience under my belt. I chose an area that I really wanted to live. And so it was between basically somewhere in Florida or somewhere in the mountains. Denver gets 300 plus days of sunshine a year. It was either going to be Denver because I love the mountains, I love snowboarding, love skiing, or I love the water, love boating, love the ocean. And just, I came to Tampa, spent a year here, and I fell in love with it. And so here we are today.
I grew up in Hagerstown, Maryland. So.
Okay. Yeah. Not too far away.
And I left there too.
Yeah. And nothing wrong. I mean, I love all my family's up there. I've got a lot of friends still up there, and they absolutely love it. It's a gorgeous place in the summertime. I choose to be where it's warm most of the year and where the sun shines, and there's, plenty of oceans and lakes and just a lot of water activity. That's really what gets me going.
So Kevin, how did you get into this?
Yeah, great question. And I've owned just about every type of real estate now over the last 20 years. But basically, while I was 19, I graduated high school. I wasn't really all that academically driven. I've kind of just skated through by the skin of my teeth. And then, a lot of my friends went away to school, and I knew that wasn't for me. I'd always been an entrepreneur. I had a paper route at the age of 12. Prior to that, I shoveled snow, I mowed grass, I did whatever I could do to make money. I didn't grow up in a rich family, so I wanted to be able to buy back then the cool things, sporting equipment, BMX bikes, dirt bikes, things like that. And so I always started working at a young age. I always tried to hustle and make money. And then, but college in my mind, that wasn't the way. Entrepreneurism, like that wasn't a term back then. That wasn't necessarily a cool thing, and it wasn't necessarily even supported, right? It was like, go to school, get a good job, and otherwise you're going to be a loser, right? Like that's what was ingrained in me. And so I felt pressure to go, but I knew if I went, I would have probably partied my
Study
way
hard,
out.
or you're going to be a realtor when you grow up.
Yeah, yeah, right. Well, so I went to community college. I was like, okay, I'm not going to waste my parents' money. I'll go to community college, but didn't have direction at that point. I was going there taking generalized classes, and through a girl I started dating, I met her mom's boyfriend. Her mom had recently gone through a divorce, started dating a guy, and this guy just happened to be a local real estate investor. It was a foreign thing to me. My parents didn't have any friends that were business owners. Both my parents worked full-time jobs, we didn't know any business owners, and so his name was David. I got to know him just from going over their home and tried to better understand what he did. I was like, to a simple sense, I knew that he owned rental properties and he lived off the cash flow. Like that's what I understood from the basic sense of it. But as I got to know him more, I saw flexibility in his life. I saw he had just had a different swagger. He just seemed to live a very different lifestyle than what I was used to growing up. And that was at that age, material things were very important, right? I want money so I can buy, cool cars, cool clothes, go on cool vacations, those types of things. And through, a couple months of becoming friends with David, he just happened to invite me to a real estate conference in Philadelphia. It was a 3-day conference. His business partner couldn't go. I attended with him. I didn't know what I was going to learn. I had never read a book on the topic. Again, all I knew is that he owned rental real estate. Didn't know how he bought it, how he got the money for it, any of those things, how he fixed and rehabbed it, how he dealt with tenants. And so I went to this conference with him, and I was overwhelmed by just in my mind, the success that I saw in the room. But what I gathered from the success was that the folks that were really successful and doing well, they weren't really much smarter than I. The folks I talked to, they just knew something I didn't know. And so I came back from that conference. I didn't want to lose the excitement. I knew it would just, kind of dissipate into thin air, and I'd go back to the normal routine again.
Quick question. That
Yeah.
conference was full of entrepreneurs, investors,
Yes. Yeah.
or real estate professionals? Because real estate conferences that I've been to aren't that exciting. So talk to me about, like, who's in the room and why are you so excited?
Yeah, guys, folks that had businesses that were fixing, flipping homes or wholesaling homes. Those were the two kind of categories that they were teaching about there. And I sat, there was two married couples that sat on either side of us, and I got to know them during the conference. Both of them, for the most part, focused on both fixing and flipping, but then also they had a rental portfolio. One owned about 40 rental homes. The other one owned, I think, 60 or 70 units. And I got a good understanding of what they made on their normal flips, which was, anywhere from 20K to 50K on a flip. And then, what their passive income stream looked like from this portfolio they had built up over the last 10 years. And so that got me super excited. And so I came back, I made David an offer he couldn't refuse. David was a solopreneur. He was really successful.
What year was this?
This was back in 1999. Back in 1999.
Is it fair to say you got to time this right? That this is not always the right year to do what you did and start your cycle?
Yeah, I mean, I think there's
always
it
at the top when it was exciting.
No, it was. That's funny. I didn't even. That wasn't relevant to me at that point in time because
it's not relevant to any. I have a college son, and so if he said, "Oh, I want to do this," I'd have to start thinking about, well, are we heading into a downturn or an upturn? And because I joined real estate in 2008, just as the bottom was falling out of the suburban market. So
sure.
Your business is historically very volatile and cyclical.
Absolutely. But
so I want to get into that.
I mean, the fundamentals don't change. I mean, we've literally had the best 2 years the growth years in our business. These last 2 years, when all of our competitors have been on the sidelines, haven't been able to buy, their liquidity dried up, what have you. And so, but most of that's because we were really conservative in 2020, 2021, 2022, when folks were kind of stretching, getting out in front of their skis, maybe buying things they shouldn't have because things only go up, right? rates are only going to stay low for forever. And so anyway, we can get into that topic at another time. But I think every every part of the year, every part of the cycle is a good time to buy. You just have to really be an expert at your craft, know what you're buying, have a good general understanding of like what worst case scenario is, and can I manage through that? Don't just underwrite the best case scenario, which is what most people do, right? They just underwrite a pro forma, and that's literally if everything goes right, all the stars align. But as we all know, that just doesn't ever happen. Pro forma's never right. Either going to, exceed your mark or miss the mark. You're never going to land right on it. So,
So what I hear you saying is you begin by saying I can make a lot of money and I can have a flexible lifestyle, and I can live anywhere. I could do this out of Florida. I could do this out of Denver. I can. So it starts with the entrepreneurial vision, right? I want to make some money and I want a flexible lifestyle and I want to work for myself. And then you found that house flippers were basically an exciting way to go, but you didn't end up in house
I
flipping.
thought, no, I didn't. I didn't.
You said,
and
"Oh,
honestly,
that's
like,
interesting, but I want to specialize."
yeah, and there's a long 20 plus year evolution, right, of buying single family homes, which is what I start with. I don't like reinventing wheels. If I find someone really successful in an area of their business, David was the only guy I knew really like that was close to me, and he had a rental portfolio. So in my mind, I don't want to go, he wasn't a big fix and flipper. He's like, look, I fix things up and I rent them, I hold them because wealth is created in long term holds. And so I was like, okay, I'm not going to argue with you because I don't know any different. And so you seem to be done really well in your life. And so I'm going to do what you're doing, David. And so that's what I did. I bought the first property at the age of 20. I went to work for him. The part I skipped, I went to work for him for a year and a half. That was the offer he couldn't refuse. I went to work for him for a year and a half for free in between classes, and I tended bar in the evenings. And I would literally go to his home office. I'd go out in the field. I'd pick up material. I'd drop off leases, pick up leases, answer phone calls, return phone calls, whatever he needed, I would do. And the biggest help I was for him is just he was that guy. He was a solopreneur, but he thought he did better, everything better than everyone else, right? And so he never had an assistant, which he really needed. He didn't rely upon GCs or anything like that. He kind of did everything himself. So I could just kind of stepped in and took some of that admin BS off of his plate. And by doing that, I learned the business inside and out. I heard what he said, when he said it, why he said it, who he said it to, and it took me about 14 months of just being around him before I pulled the trigger. Bought my first property, and I learned very quickly that the buy and hold strategy that David leveraged, which he had been doing this now for 20 plus years. I bought that first property, got it rehabbed, leveraged a lot of his resources. I met a lot of people through knowing him, and I got it rented, and it threw off shy of $300 a month of positive cash flow. But I used pretty much every dollar I'd saved up tending bar to buy that as a down payment. I had a private lender that financed the rest, and I realized that there's no way I'm going to be able to buy another property anytime soon because I just used all my money here, and that $300 a month that's throwing off, it's going to take a very long time to save up enough to buy the next one. And so I modified the business plan, started basically wholesaling a couple properties, just this literally not fixing them up, just wholesaling them, and then holding maybe every 3 or 4, right?
Wholesale means you buy it,
buying it at a great price,
money, or you just move it.
Sometimes it's just signing up back then it was legal. At some states it's illegal now, but just literally signing up a contract for X price and then selling it for Y price and then making the spread in the middle without doing anything. But basically identifying a great property for below market value and then selling it to the most people that were buying from me were folks that were going to fix it. They were going to fix it. They were investors, but they wanted to go through the entire process and life cycle and fix it up to its completion. So, but that was the initial model, and then it morphed from there. I did build up quite a big rental portfolio in my early to mid 20s. Got into multifamily investments. Started dabbling in other types of commercial real estate, retail, office back when it was cool and it was a good thing to be invested in. Self storage and some industrial, and then I guess trying to fast forward to where we're at today. I lost everything in '08. Took a 3-year hiatus. Bought my first mobile home park, which is what we own today. Bought my first mobile home park back in 2011. And
why did you buy that?
It's a great question. I never had intended to buy it. I didn't know anybody that had owned mobile home parks. Honestly, I did a look back kind of valuation on when I lost everything, about what my business looked like, where the mistakes were made, And now second time around, how can I do this again and not go through the same, chaos that I went through the
I
first
was just
time
about to
around?
ask you, do you have to fail? Is it a truism that everybody in the mobile park business has to fail once before they
Yeah.
learn the lessons you learned, which is we have to get real conservative with our spreadsheet and our projections.
Yeah.
Um, and that's why you're saying all of us who've never bought gotten into real estate before, we can learn from you. We should have a mentor like you who's not going
Yeah.
to let us get into trouble.
Yeah, I mean, I think everyone. I mean, if you're going to be an entrepreneur, I mean, you're going to fail multiple times. I don't look at it as failure though. I just look at it as lessons. I mean, how do I do it better second time around? How do I not make the same mistakes again? I mean, you guys are entrepreneurs. That you've spoken to hundreds or thousands of entrepreneurs, and you'll find that the most successful ones have had many more failures than they've had wins along the way. And but typically the wins are so significant that they triumph all the failures, right? And they wouldn't get to that win without all those failures along the way. So it was a chaotic time. It was rough 3 years. I literally lost everything, my primary residence. It wasn't mobile home parks though. It was I had about 122 single family properties and a couple hundred multifamily doors. It was down here in Florida. Florida, the economic base of Florida was, especially Tampa Bay, was very different 20 years or 15, 16 years ago, back in '08, than what it looks like today. It's much more diversified in nature, from the employment base and it's just the population growth that we've seen over the last 10 years. It's a night and day difference of what it looked like back then. And the biggest challenge we went through back then was this is, back with the, basically you could fall a mirror, could get a mortgage. The amount of spec homes that were being built in Florida, all the major markets, Orlando, Tampa Bay, Miami. Jacksonville probably experienced a similar thing. The population wasn't coming here for it. And on top of that, basically a lot of the job base here was built around construction or the real estate industry. And so when the mortgage
And
crash happened,
retirees, right?
yeah, yeah, but there were so many rooftops that were being built. This is back when some homes pre-construction would get flipped 3 times, right, for a profit, and that just none of that is sustainable. So like when the market finally crashed, you had a lot of builders that had new home inventory. They started renting them out. We had a rental portfolio. I mean, literally, there's more homes than there are people, and also now people have bad credit. People have lost their jobs, and so we just experienced a point in time where we had not a mass exodus, but we went from 98% economic occupancy to about 82% economic occupancy within a matter of like 4 or 5 months. It was insane, and it got below that, and then the
Is
values
82
literally.
bad?
82 is not great. I mean, not when you go from 98 to 82 in a
Well,
in a
I'm
couple of
thinking about
months.
like American Airlines, and if they got 82%
I was
occupancy on their flights, they're probably like, okay, I can make money at
Yeah.
this.
I would say about 80% was about our break even with our debt service, but we dipped below that for many, many months. And on top of that, the values literally, we had before the crash happened, our loan to value across our entire portfolio was below 60%. So one would argue that is incredibly conservative. There's a lot of buffer there, but the majority of stuff we owned within a year was underwater. It was below what the at least half or less than what the original value was. Sometimes way less. Sometimes 30 cents in a dollar is
And
what
you
these things are
couldn't
trading for.
restructure the loans. You had to actually go bankrupt.
Yeah, I didn't go. So I didn't go bankrupt. I never filed bankruptcy. I am proud of that. I worked my way through it over many, 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 many years. But no, because what ultimately occurred is this was such a new thing for these banks. None of them had workout departments. None of them were ready for this onslaught. And so most of the banks I had relationships with were local community banks, and their books were already a mess. I mean, their portfolio was a mess across the board. They didn't have the wherewithal, the manpower to manage it. They didn't have the structure, the mechanism in place to actually do workouts right out of the gate. Maybe a couple of years into this, they did. But so I didn't have options. They weren't willing to have that discussion. They're like, basically, you got to pay these loans in full. I don't know what to tell you. And I didn't have the ability to do that. There was no equity left. We couldn't refinance them. The mortgage market had completely melted down. And so it was basically, cross our fingers, do as much as we can to get good residents in there, to get them to pay, to renew leases. But that was tough. We had to cut rental rates. We had to give concessions. We still had a ton of vacancy on top of that. A lot of our maintenance guys left. I mean, they're just they saw kind of the writing, so a lot of our workers kind of moved away. It's hard to find new workers to replace them with, and it was just a tough time. I mean, it was just like, you know, all the stars aligned in a bad way, and I couldn't find my way out. And so
So
In
when you
any event.
fail, so let's get
Yeah,
to the
yeah,
present. So when you
yeah,
fail at single family portfolio, mostly because the economy was so bad, nobody could make money, and you come out of that, why trailer parks or parking
yeah.
lots or mobile
S-
homes? Did you
So
just
yeah, so what I saw is that my single family stuff back then was very inefficient. The management of it. I owned it in 5 counties. This is back before you could do virtual showings and lots of online presence. So we were physically putting out for rent signs and had leasing agents driving around doing showings, and it was incredibly inefficient.
because Roberto and I and every other realtor in the country gets a call occasionally who's from somebody who says, "I think I want to buy real estate and rent it out. I want to buy this.
Yeah.
Can you find me something I can rent out?" And I say, "Well, what were you thinking?" And they identify something, and I'll say, "The rental on that, you're going to make 5, 6% of your money." And they're like, "That's good, right?" And I'm like, "No, no,
No,
that's
you could do
not
better.
enough
You could do
to
better.
actually." Borrow money at 6% now and turn it all over, you're going to be on
Yeah.
underwater on day one. And
Yeah.
a lot of people don't understand that. It's one of the reasons, I guess, why you went. There's so little margin for error is why you went under. Now, what kind of return are you looking
Well,
for?
and our margins weren't thin back then. You could buy $100,000 house and rent it for $1,000, $1,100 a month. So that wasn't that wasn't. I think it's very different today. There's probably still parts of this country. I'm sure some in the Midwest where you can actually buy a home and actually make a decent return, probably 8 or 9% renting it.
I've asked
But I
Roberto,
think
can
it's
I buy and rent it out in New York? And he's like,
well,
no, you
no,
cannot run
not in New
that
York.
business, John.
Yeah, maybe in Indiana or Ohio. I'm sure there's markets where you can make the numbers work, but
Can
it's
we get back? I want to get back
yeah,
to you saw this. What
yeah.
did you identify and how did you say this is a business model that I think that I
Yes.
can make work? Like,
Yeah.
I don't understand.
Simply put, the rebuild stage, I had identified that my multifamily properties were way more efficient, hands down. And it took me, I could go buy a 120 unit apartment building the same time it took me to buy one single family home. And I busted my ass to buy 122 single family homes. And so I knew the next time around. Now I was married. Now, fast forward, I got married in 2010. We wanted to have kids. And I'm like, I need time. I need to rebuild, but have a life work balance. I need to be more efficient and smarter with this rebuild. And so I thought it was going to be multifamily. I met a guy, an ex banker. He had recently retired here locally. Had lunch with him. He happened to own mobile home parks. I mean, it was that's the first time I'd ever talked about mobile home parks. But this 2 hour lunch meeting I had with his name was Randy. He piqued my interest in so many ways, and he intrigued me that I left that meeting and had a complete change of plan. Had committed at that point to go buy a mobile home park and either prove or disprove all these great things that Randy had said about the asset class. And so I did that. I went and bought, made a lot of offers, looked at a lot, got cold feet a million times, but ultimately bought the first one in Atlanta back in 2011. It was a 34 space mobile home community and it was complete rundown REO. I'd been sitting vacant for a couple years, turned it around, stabilized it, did a cash out refinance, went
So it
pretty
was
well.
sitting vacant, meaning it was just a piece
Yeah,
of land.
no, it was an interesting story, and it's not
That's a
common.
shocker. When
It's
you
not
say that,
common
we're like,
to
oh my
yeah,
God.
it's not common to what we buy today. But basically the old owner went and bought 34 brand new trailers a couple years prior, took out a bunch of debt on it. He was kind of a slumlord, so he ran it like a slumlord. So even though he brought brand new homes in, he continued running a slumlord, and just he defaulted on the note. Got taken back by the bank, and the special servicer took it over, and for some reason, unknown to me. They actually made all the tenants leave. They were all rental units. They didn't own the homes. They were rental units. So they vacated all the tenants, and so it sat there vacant. Obviously, got vandalized. People stole the AC units and all that. So when we bought 34 mobile home lots on a 3 acre parcel of land, but there was 34 mobile homes that were all 5, 6, 7 years old, all in need of renovation, but all vacant, so no income whatsoever. And so we dove in head first and got a couple
In
construction crews
retrospect,
together,
it was
and
a good idea.
oh, it was a
Knowing what
great
you know
idea.
now, would you buy that
Yeah.
at that terms?
It wouldn't be a good fit for our business today. It's a little too small. I mean, it's just, there's always so much bandwidth and resources we have, and they're better spent in our organization today buying larger properties at a larger scale. But
Should
I mean,
Roberto and I buy something small like that, 34
well, I don't know.
units?
Let me tell you, I paid 280 for it. We put about 200,000 of rehab into it, did a cash out refinance. in month 13, pulled all of our original capital back out of it. It appraised for 1.3 at that point in time, and I just sold it like 3 years ago. I held it for quite some time. I sold it 3 years ago. I think we sold it for 1.6 or 1.65, somewhere right around there.
So
So I would say
what,
it was worth it.
what,
And I would
what, when you go, what does a park like that need to have? Does it need to have gas? Does it need to have water? I mean, like, what are the things, the structural
You
things?
want me to pull up the case studies, Kevin?
yeah.
No, but I mean, like,
Yeah.
generally, you go there, like, what are the things that you need to be concerned about? Like,
Yeah.
what amenities do you have to be provided in order to classify it as a mobile home park?
It doesn't need amenity. I mean, we own some communities where there's zero amenities, meaning that like there's homes in a community, but there's no clubhouse, there's no swimming pools.
I don't mean
no
stuff like that necessarily. I mean like things like running water, like gas pumps, things like that.
Yeah, no, I mean it's just like think of a single family subdivision. It just happens that we own the entire parcel of land that has all the homes on it. So you need water lines, you need sewer lines, you need roads. Some of them have gas, some are all electric. It just really depends on the part of the country that it's in. And so literally the same elements that you would have in a single family subdivision are the same elements infrastructure wise that you would find. This is a recent community that we just purchased December of last year. This is about 15 minutes outside of Ann Arbor, Michigan. Absolutely gorgeous community. Owned by the same family. They developed it about 40 years ago. It's got you see a big fountain in the pond in the front. This looks like a single family subdivision. It's got all the elements of a single family subdivision. It's got tennis courts, it's got basketball courts, 2 playgrounds, a big walking path around the pond. And all these residents own their own home. They basically they lease the land that their home sits on. And that's where we make our money. We make our money by owning the entirety of the property, providing them amenities, providing them infrastructure, maintaining the infrastructure, and for that they pay a monthly lot lease.
So if someone wants to, let's say they own their home, they have it on your land, they're done. They want to, say someone passes away or whatever, they're done. The family comes by and say, listen, we want to dissolve ourselves to this. Do they pick up that house and move it away, or do they sell it to you, or what happens?
That's a great question. I mean, technically, they could pick these are mobile. While it takes a professional licensed mover to move them, and it costs money to move them, they are mobile and they can be moved. And so they sure that they can be moved. However, what typically happens, because it's such a costly endeavor to move them, it's a lot of effort to find the right people to do it. Most of the time what happens is they put it up for sale, just as though they lived in a regular single family home. They put it up for sale with a realtor, or they put it up for sale by owner. They put a sign out in their yard, but you put it on Facebook Marketplace, whatever method is viable in that particular marketplace. They'll put it up for sale. They'll sell it. While they're marketing it for sale, they'll continue paying their lot rent payments to us. Once they find a prospect to buy it, that person will come through our community. They have to get qualified. They have to make sure that we don't want to just them selling it to any Joe Schmo. We want to make sure they don't have felonies and criminal backgrounds and things like that. But once they get qualified by our community, that new buyer assumes the lot rent, responsibility, and we continue going on, and they're the new homeowner. So I would say that over the last 10 years, we own about 3,500 lots a day. We've owned probably anywhere about 7,000 or 8,000 over the time we've been doing this. I can count on 2 hands how many homes have actually left our community. If they do leave the community, it's because it was too old when we bought the community. Maybe the home was too old. It was run down. No one was living in it, and we just tear it down. We bring a new one in. We'll tear the old stuff down and bring a new one in. But very rarely do actual residents take that home and move it somewhere else.
As a purchaser of, like, I want to live in your mobile park, what are my considerations?
Yeah, obviously the neighbors, neighborhood, management, amenities. Just like the things
I like
you look
the design of this one. I like it. I like all the diagonals.
Yeah, so that's an interesting community that we bought that one at the end of 23. It was 2 communities that got merged into one, not by us, but by a prior ownership. But it's huge. It's 738 sites. I mean, it's the size of a small city. That's in Fort Wayne, Indiana. But back to I'm sorry, Roberto, your original question. I lost my train of thought there.
Well, like, as a buyer, like, what are my considerations when I'm coming there? Like, I'm concerned about what, and what do I have to, aside from my essentially lease payment to you, what else do I need to be concerned about?
Assuming the house is there and they're buying a house that's already in place, it's already set, it's got utilities hooked up, then it's the same things that any other, maybe family that's moving to an apartment or a regular single family home might take in consideration. If it's a family they've got kids, what's the school district? Where are the public schools? How far away are they? Is there a bus route here? Is there a bus stop inside here? Is there, what type of amenities, swimming pools? Are there other families that live in here? If not, if it's a senior, maybe if it's a senior couple that are looking for a place, hey, how many families are here? Maybe I don't want to be here because there's too many kids running around, right? I want more of a 55 plus, age restricted community. But again, just to make sure that they're in the right part of the marketplace, that there's, it's safe, it's clean, it's quiet, it's kept up. Again, because really the responsibility of us being the community owner is make sure that the roads are in good shape, making sure that the common area is in great shape, make sure that we're enforcing rules, right? Like you never want to live next to the neighbor that, it's got, 80 potted plants outside and a car with flat tires and they're working, changing the oil in the driveway, right? Like, so just ensuring that the actual community is enforcing the rules and creating consistency across the board. I would say those are some of the big ones.
How difficult is it to go into these municipalities? I mean, like you're in Fort Wayne, you're in Atlanta, and to understand the local knowledge of taxes, how they
Yeah.
feel about it, what sort of money you can get from them, how how often they deal with the sewer system, all that type of stuff. How difficult is it to get that local knowledge?
Yeah, no, I mean, we rely upon a lot of experts when we were going through due diligence. We hire, we'll hire local counsel, engage local counsel, local engineers, folks that know the, planning and zoning laws. So we'll just really lean on the resources that are there at the local marketplace. And then on top of that, we typically don't buy smaller communities. And kind of back to the point of you asked the question about would I buy that, that very first community we bought up in Atlanta, would I buy that again? And while it was a great deal, we made a lot of money. It's just not of a sizable enough scale to where if we're going through due diligence, we're spending a lot of times $50,000, $70,000, $100,000 before we buy a community, and that's to engage local professionals, folks that know the answers to the questions that you're posing there. That's how we do it. And that's how we do it in short order. It's just finding the folks that have the knowledge and engaging them, bringing them on our team, even if it's only temporarily, to help us navigate all those various complexities. And then, we tend to buy, if we buy something in one market where we don't own anything, we have a plan to expand that footprint. So it's kind of like you got to learn it one time, but once we buy that first community and we're successful with it, we typically work really hard to expand that footprint in that local marketplace. We've already got the local knowledge, we've got the resources, we've got the folks that we can lean on that have the localized knowledge and all those things that help alleviate risk associated with any new investment.
Can I ask about the case study in front of us now? This is a
Yeah.
high-end lakefront community in Ohio, and it looks like really well. When they say high-end, I mean these are beautiful lots and everybody has a view of the lake. And I have to say that's kind of unusual. Is this a seasonal community or is this year-round?
It's for technical purposes, it's year round. However, there's only it's about 20% of the residents live there year round, and so this is a unique community. Every one of those home lots has waterfront dockage, and so in the summertime they all have boat. This is a really popular recreational lake. It's about 45 minutes outside of Columbus, Ohio, so major market. And so a lot of the residents that live here, these are their summertime cottages. Folks that live in Columbus and the Columbus MSA, these are their summertime cottage. They come here and spend an entire summer or spend weekends. They play pickleball. We just install. If you go back there's a pickleball court we just put in there. The demographic here is it's a little older. Folks might have kids, but it's a higher end demographic. It's folks that can afford to have a second home, second vacation home. These average units, even though some of these homes are older, the inside of these, if you went to Zillow right now, and there's about 3 or 4 that trade every year. If you looked at the interiors, you'd find that folks, they invest $50, $60, $70,000 on complete revamps on these interiors. It does not look like the outside. The average home in here sells for about $140,000. Some have sold for as high as $200,000.
What kind of rent do they have to pay for the lot that they're sitting on?
So right now, I think that community is at $900 a month is what they're paying for lot rent.
And so it occurs to me that all right, I'm going to ask a very delicate question right now, but in the newspapers, we hear about companies like BlackRock are moving into this kind of business. They're buying up residential real estate all over the country and they're jacking up the rents. It occurs to me that a BlackRock could buy this and double the rents to $1,800 a month. And what are you going to do? Move your trailer? You're going to move your mobile home? You're going to sell it to somebody else without a lot? I mean, so I think a lot of people are nervous that the emergence of hedge funds into this business is going to be massively disruptive. But I wanted to stop at this point in the video because you can see that there's other land available. There's a lot of farmland even available in this community. And so the reason I guess that a BlackRock can't do that is that if the community revolts, then they'll change the zoning.
Yeah, not
truth
not
to
too much.
that?
One of the biggest, I mean, there's a couple questions you have there. One of the biggest barriers to entry with this investment, and one could argue that it's it's in favor of owning these, is that it's very restrictive as far as municipalities allowing new mobile home parks to be built. And so, in fact, over the last decade, there's been like 5 new communities that have actually come out of the ground, brand new communities. In fact, there's been way more that have shut down or been redeveloped.
That's why
into higher and
BlackRock
better
does
uses.
it, because once
Yeah,
they're
but
in,
but to your point,
they're in.
yeah, well, to your point, would someone move their home? And look, every market's got a ceiling of what someone's willing to pay before they decide to move on somewhere else. So, it'd be tough to say that could we move it to $1,800 a month, and would people stay there, living there? Possibly, probably not. Because really, what we try to be competitive against is what is the cost of a. This is the only mobile home park on this lake. It's the only one. Everything else is a single family home. And so, what is the if someone the comparable, what's it going to cost somebody to go buy a waterfront single family home that's of similar square footage, a small cottage, 1,200, 1,400 square feet? What's that going to cost them all in? And right now on that lake, that's going to cost you about $800,000 or $900,000 on the low end. And there's plenty that are north of $1 million. And so we want to be incredibly competitive. We want to have a really compelling storyline of why you should never leave here, because this is the cheapest option. While 900 might seem like a lot, and while we're going to carry with inflation. I mean, inflation's still rolling right now, and so our insurance costs go up, our taxes go up, and so we typically have rent increases on an annual basis. But we don't go in and raise rents hundreds of dollars or 50%,
But as your
100% like you just referenced. But
as your investor talking, I believe that this feels pretty safe, what you've just described to me, because
yeah,
you're charging 900, and I feel like even though you're telling me you can't charge 1,800, I feel like there's a big gap between that $150,000-$200,000 mobile home and that $800,000 floor on the single family home, and that I have my investment is pretty safe with
I would
you.
say so. And a lot of folks that live in our community that are paying, like, they wouldn't be able to afford that $800,000 home, right? Like, it's just, they enjoy the same things. They obviously love being on the water. They love the lifestyle, but maybe they make a collective, household income of $400,000 a year. Whereas the guy that's got the $1 million house that's just sitting there, 9 months out of the year, he's probably making $600,000, $700,000, $800,000 a year, right? Because he's got a great house in Columbus, and he's just got this other $1 million house that's sitting here the majority of the year that stays vacant. So, again, I get the point, and again, I'm not arguing that we couldn't raise it or double it. That's not our business model, but I think there's a ceiling at some point. Something that we argue is attainable housing or affordable housing. This is a little unique. This is probably an anomaly community when you compare it to everything else we own, because pretty much everything else we own, it really is the most affordable option in the immediate marketplace, but it's typically their primary residence. Whereas this one, these are secondary residences. It is affordable housing in this unique recreational area, but it's secondary housing. So again, kind of an anomaly there. But there's a ceiling that everyone has. Everyone's got a ceiling. You hit it, guess what? You're going to lose occupancy. You're going to lose people. It's no longer a compelling enough reason why they should be living there, and they're going to move on. And I don't know what it is there, but.
So Kevin, let me ask you something. So is your business, like, is this a competitive field? And also, I mean, a secondary question to that is, let's just say one of these, you wanted to sell one of these.
Mm-hmm.
What is do you going to sell this to a local person most likely? Are you going to be dealing more on a nationwide scale? And if you put, it's all price, but if it's the
Mm-hmm.
price is fair, would you expect to have many interested people, or would it take time to identify the right person?
It's an incredibly competitive landscape today. If you asked me that question 10 years ago, 12 years ago, I would have had a slightly different answer. I'd said it's competitive, but there's a lot of opportunity out there. It's a night and day difference today. It's an industry that was incredibly fragmented a decade ago, but it's really consolidated now because a lot of institutional capital, BlackRock you'd mentioned, there's a number of others as well that have come into the space. And the problem is that you've got these big groups. They don't like writing checks for 1 million or 10 million. They need to be able to deploy hundreds of millions of dollars in one fell swoop to have it make sense for them. And you got this higher demand that's continually coming in day after day, year after year, but no new supply. And
Are
so
they
it's incredibly
moving
constrained.
down market because they can't buy billion-dollar investments, so they go to 500 million to 100 million? Are they now going down market and making $50 million bets because that's all that's left?
Yeah, I mean that's kind of the trend that's been happening. And so even in our space, there's not many single mobile home communities that will trade for $50 million. Whereas in apartment community, there's plenty that will trade for $50 million, and it's just not all that commonplace. And so, but they're buying portfolios. But yes, to answer your question, whereas maybe when they got into this space, I remember having conversations with the rep from Carlisle Group, 6-7 years ago at a conference, and like they were coming in all hot and heavy, thinking that they were going to be able to deploy $1 billion into the industry. And like that quickly changed over the last 6-7 years to, we sold a community to, it wasn't Carl, I'm not going to name the name, but we sold a community for about $17 million to one of these big institutional groups. And that was one transaction, 17 million, which prior to that, they would have just brushed off. That's too small. We need more than that. So I think they've realized if they want to get into the space and they want to have it as part of their holdings, these transactional sizes are just typically smaller unless they can accumulate a large portfolio. But again, even in our industry, big portfolios that transact for hundreds of millions of dollars just aren't all that common. I think the largest transaction to date of a portfolio within our niche was roughly $400 million. And I might be wrong on that, but like what I recall in the last couple of years, $400 million was the largest single portfolio transaction within the MHC space.
And that would have been about how many parks? Ballpark.
Yeah, gosh, I don't remember. I think it was I think there was 70 or 80 of them in there, give or take, and all various sizes as well. But
so you're in Tampa. Mm-hmm. You have this place in Fort Wayne. How many people do you employ in Fort Wayne?
Yeah, so our company's kind of bifurcated down the middle. We've got an investment arm, which basically is our capital raising, our acquisitions, dealing with our investor base. And we've got, I think there's about 15 or 16 folks in that side of the organization. However, we're vertically integrated with our property management. And so we employ everybody, both on the ground level at each one of the communities, as well as on a hierarchy of our regional vice presidents, director of operations, support roles, and all that. And so each one of our communities at minimum has one community manager. Like the smaller ones, this one we're looking at here, this is the smaller, it's about 100 spaces. There's one community manager there because it's pretty small. That's all we really need. But then that larger community in Fort Wayne, 738 sites, there's a community manager, assistant community manager, 2 sales and leasing agents, and 2 groundskeepers. And so between all the communities that we have, and then the external staff in the property management side, I think there's about 70 employees on that side of the business.
There's no amenities on this one. What's the kind of rent and what's the kind of purchase price in a small community like this in Ohio?
Yeah. So this is an interesting one. Again, this was a recent acquisition. This just happened to be we call it a bolt-on. This is about 10 minutes away from that very large one we looked at. This is probably about our threshold of like the size, meaning like it's if we didn't own the other community in Fort Wayne, we wouldn't have bought this. And then on top of that, this was a little rougher than we typically like to deal with today. It just needed a lot of cleanup, a lot of improvements, but we got that at the right price. And again, we have quite a big, quite a lot of manpower at our other community 10 minutes away, and so we justified the purchase of it. But your original question, I'm sorry, John. The original question was
rents and returns.
Rents. Yeah. And so in this community here, I think when we bought it, the lot rents were at $280 a month. We bought it from a guy that had owned it, I think for about 16 years. So he just got pretty lazy over time. He was an out-of-state owner, didn't really, have his finger on the pulse. $280 when we bought it. I think the lot rents, we've only owned it for a short period of time. I think we just did our first lot increase. I think that the lot rents are now $340 a month. So still very affordable. The market here, meaning that like what we target as like over the next 5 years, where we'd like to be, is probably somewhere in the $500 a month range. So still, again, incredibly affordable for
to get there. To get to that, do you have to commit to sprucing this up quite a bit?
Yeah. So we had a pretty big capital budget on this one. It doesn't show it in this video. This video was taken before we closed on it. We get drone footage and all that before we close. So, but we're redoing the roads, put a new playground in. We got rid of a number of homes that were old and kind of just junkers and abandoned. I believe we are doing quite a bit of tree work here. A lot of landscaping, new signage all throughout the community, stop signs, street signs, things like that. It doesn't have a clubhouse. It doesn't have anything like that. And so really we focused on the central area right in the middle there it was a playground. It wasn't much of a playground, but we've got basically like $100,000 worth of playground equipment we'll put in there. Pretty elaborate playground because 80% of these homes in here have kids that live here. And so they need some type of park-like setting that they can spend time at, gazebo, picnic table, so they can do cookouts. We'll have some grills out there, and just make it more of a socialized center of the community. But yeah, I think we've got about $500,000 that we'll end up investing in this community. I think we purchased it for just under 2.5 million. And so when you look at it proportionately, quite a bit of capital put in based on the actual acquisition price.
And you will hold this.
Yeah, so I mean, we like to everything we look at, we like to think as though we're going to hold it for 10 plus years. If we were ever to sell this, we would sell it in combination with that larger community that we own in Fort Wayne. We wouldn't sell it by itself because we're not going to yield we'd get a higher yield and a lower compressed cap rate if we sold those two together to a larger institutional type group than that if we sold this individual one by itself. That still might be a decent sized group that buys it, but it's not going to be as competitive and as aggressive as a buyer as if we paired it with that larger community that we have.
Yeah.
I don't want to end the hour without asking, if I invest, how do I invest? How much, how little can I invest and try this out? And what kind of cap rates, what kind of a return, and what kind of range? I mean, I think that the waterfront community is awful sexy, and I think I want to get in on the waterfront mobile home park. But if you tell me that this one here in Fort Wayne, Indiana, is going to give me a 15 cap, then I'm like, sign me up today.
Yeah, that's funny. So unfortunately, that waterfront community, John, it's in our third fund, which is currently closed out for new investment. So unfortunately, you can buy a home in there. Go to Zillow. There's probably one for sale now, so you can get your little pontoon boat and.
No, I want to be on your side of the desk.
Yeah.
Collecting the rents, not paying the rents.
And I know once you move in, I know that you're comfortable paying $1,800.
He's a broker,
so we'll do that.
He's a broker too.
Yeah, so we do a fund structure. So we don't buy one-off investments and look at them as a standalone investment. So we typically roll out a fund. Right now we have SEI Growth and Income Fund 4. And it's a combination of not just mobile home parks, which is what we talked about today, but also we own parking garages and parking lots. And so, SEI Growth and Income 4 will be open for the remainder of this year, and then we'll basically be rolling out fund number 5 at the beginning of 2026. I think at present time we've got about 120 million of assets inside of this current fund 4. You have to be an accredited investor to invest. You can go to our website, sunrisecapitalinvestors.com, learn more. We've got a webinar. You can click that.
We're on the page now. And
yeah. So if you click that, it would give you a form to fill out, but then it'll give you access to a recent webinar we've done. You can schedule time to talk with one of our investor relations associates.
Well, take me through these numbers.
What's the minimum investment?
How do they compare to other funds? Like, is this good?
I think it's great. $100,000 is the minimum investment. Target annualized return 16%. And again, we run this out over a 5-year span. However, we always tell our investors we like to make sure that we align ourselves with the right investors. Anything we buy, number one, they're not making more mobile home parks. They're not really making more parking. And so when we find a great asset, while we might underwrite something over a 5-year span, we also look at it over the 10-year horizon, maybe even longer than that. And so we want to make sure that whatever investors get involved with us, that they've got a longer term mentality, that they're more of a, kind of set it and forget it, and just receive the mailbox money on a regular basis, rather than that individual that might be just getting started, might be an accredited investor, but really needs to put an emphasis on recycling their capital. Like I'm going to put $100,000 in, but I expect to get it back in the next 2 years, 3 years, so I can turn around and put it into something else. So we're kind of, a lot of the investors we work with are in the wealth preservation stage. Like they've made it in another business, in a profession, and they just want to put in good, solid investments that give a solid return, that pay out distributions on a quarterly basis, and that they don't have to think about a tax event every couple of years when I tell them that we're selling, a whole slew of assets.
What does that mean? 16% and 8%.
Yeah, so that's based 16% is based on the IRR, internal rate of return. So the splits there that as it references. So basically, all of our investors they get every distribution until they get their original capital back, and then after they get their original capital back, we make up any preferred return that's accrued. And so once they've been made whole entirely, at that point in time, myself, my partner, we get to participate in what's called the promote. So we end up getting 30% of the distributions. Investors get 70%. If there's any capital events, cash out refinances or sales, the proceeds are split 30-70, 30 to us, 70 to them, and that's for the life of the deal thereafter.
So if I invest my $100,000 in fund four closes at some point, and I get my distributions each year or each quarter until what, 5 years, 10 years, after which I could get my capital back and you close the fund?
Yeah, so typically how it works is we'll close out the fund at the end of this year for new investment. So we won't take any more investment dollars into it, but that doesn't mean that we're selling the assets. That means that we're just going to open a new fund so we can. The SEC has some guidelines around how long an open-ended fund can actually accept new capital. So we basically are working. Our normal funds stay over 2 years, but we might own those assets for 7, 8, 9, 10 plus years. And so what would ultimately happen is, typically what we project is somewhere year 4 to 5, we'll have all your original capital back to you. That will be a combination of distributions. That will be a combination of cash out refinances. Once we have all your original capital back to you, we'll split the proceeds of the cash flows, 30 to us, 70 to you. If we sell at year 10, whether it be one property or all the properties in that fund, those proceeds of that sale event will be basically split up again, 30 to us, 70 to each one of the investors. If it's a single property inside that fund, it's proportionate to that individual property. If it's the entirety of the fund, again, same thing, 30%, 70%.
We haven't talked about parking lots, and I'm just curious, parking lots, parking garages, things like that.
Yeah.
Is there, because of all the EVs that are coming, are you experiencing a tremendous capital expense to kind of retrofit a handful, at least a certain portion of it? Or, I mean, how are you attacking that eventual demand?
Yeah, no, it's a great question. It's a case by case basis. And I would say that there's quite a number of companies out there now that are really targeting parking owners. Electric, EV charger providers, whatever you want to classify them as, service providers, that basically the equipment guys. And so there's a number of groups out there that ultimately will even go as far as paying for all the necessary infrastructure and the modifications that are needed to whether it be a parking lot or a parking garage, so that the actual owner doesn't have to come out of pocket. So we actually just did a small little test run with a group on an asset that we have in Phoenix. I think there's 12 charging stations that we're putting in, but ultimately it's not costing us anything to do that. So I think that.
Wow.
I'm not saying it'll be that way forever, but I think at this point in time, I think there's an opportunity on that business side of it to actually get their footprint, and expand their network inside of various parking structures throughout the country. And so for that reason, they're maybe taking it on the front end a little bit, and kind of a loss leader on the front end to pay for the infrastructure so that they see the long-term benefit in the long run and, probably find an exit, 5, 10 years down the road. So it has not been something that we've had a budget for, which is kind of a beautiful thing.
So one question, one more question. You have a lot of questions, but you're all over the place. You're in Atlanta, you're in Indiana, you're in Phoenix. Where are these opportunities?
But he's not in Florida. He's not in Florida.
He's in Florida. I'm joking. No, but how are you fielding these opportunities? Are they coming to you? Are you seeking them out?
All the above. I would say up until 3 years ago, 90% of what we bought were based on our own efforts, basically cold calling owners, building relationships with them, building rapport over long periods of time, and hopefully us coming to mind when they made the decision to sell. I'd say in the last 3 years, that's changed a little bit. A lot of these larger properties that we've been buying, larger scale properties, most of the owners typically don't want to sell it directly to another buyer. They want to leverage a broker, the expertise of a broker to play, the middleman and just facilitate the transaction. So I'd say over the last 3 years, it's kind of gone 50-50, where 50% of what we buy is through a broker relationship. And the other 50 is still kind of long-term relationships that we've had for many, many years with owners.
Wow.
So,
Roberto, you want to do another hour right now, or we're gonna we're gonna bring him back another time?
The landscape is wide open. I mean, I'm just lots. I guess there's lots of opportunity, yet competitive, and yet, you got to know what you're doing. It's a niche.
I mean,
yeah,
we just scratched the surface today. Yeah. All we've gotten is, I looked around and I got into house flipping, and that's how, it didn't work out. So when I came back,
it worked out. It just didn't work out, for a very long. It worked out for 7 or 8 years, but then
it didn't work out.
Hit the reset button.
With it didn't work out with your ambition, where you're like, I'm not doing one house at a time. I'm going to do 30 and 50 at a time. Yeah. No, I'm going to do, funds, and I'm going to fund massive portfolios. And so we haven't even gotten into how you pick your properties, and we haven't really gotten into that. We've just scratched the surface on the economics of this.
Yeah. And that's the fun stuff.
We should do another one of these specifically on parking lots.
Yeah, I think I would love that.
Just do parking lots for a whole hour, because I'm fascinated with parking lots. I have a parking lot at my building, and I know that every spot is so precious in the lease, and everybody wants to know, am I getting 1 spot or 2 spots? Don't you take my parking from me? And so being on the other end of that, where you're a dispassionate investor of parking spaces, it's a very emotional thing for me. That's what I'm trying to say. Maybe not for you.
It's an interesting niche. I mean, it's one that from the outside looking in, it seems pretty basic in nature, but it has way more complexities of who the parkers are, when they're coming, when they're going, the dynamic pricing model, being competitive with other parking options in the local immediate marketplace. So there's a lot more moving parts to parking than what meets the eye. And so it is a fun industry. We studied it for 3 years. I interviewed a guy on my podcast many years back, and I was so intrigued. He owned some parking lots, and I just like you, I spent an hour with him, and then I flew him to Tampa. I'm like, man, I gotta learn more. I have so many more questions. And then we studied it for the next couple of years, went to conferences, met other people in the business, and then finally pulled the trigger back in 2020, bought our first parking asset, and it's been a fun ride. But it definitely is. It's interesting because everyone's a little different. Demand drivers are different. Like, who are you serving? You're serving cars, but where are they going? And
once you pay $100 to park your car for the first time in Manhattan, it's possible, right, Roberto?
$100. I pay like $750, and that's like, and people are like, $750, not bad.
That's a month, right? That's a monthly. But if I go into dinner and it costs me $60 to see to park when I go see a Broadway show,
2 hours,
and then I go park in one of your parking lots, and it's like, oh, I don't know. I mean, average parking in America, it's $2, $3, $4. I think to myself, man, you guys aren't charging enough.
Well, here's the thing. We own a parking garage. I like to say that parking, if you buy in the right location, it's got inelastic demand, and that, we've got a parking garage here in Clearwater Beach, and there's a moratorium. You can't build more. We actually bought it from the city. They built it, and they did a horrific job running it. And so we bought it from them. And basically, I like to make the joke of, like, if you're driving with your family of 4, you got your kids in the back, you've already spent some time in traffic getting down to the beach, you're driving around, it's chaos, you're trying to find parking, your kids screaming, right? They got to go to the bathroom, you got to pee.
It's worth whatever you're charging.
You will pay if it's $20, $40, $60. You're going to pay whatever that number is. Not that, like, we don't take that approach per se, but you will pay whatever is on that sign if there's available parking there, so that you can stop the screaming, stop the yelling, get the hell out of the car because you've been in it too long now, and your kid's got to go to the bathroom. He's going to pee himself, right? So
you talk like it's an exception. I pay $100 every time I go to Yankee Stadium.
Yeah,
every time. So. And I don't need
Kevin, this was awesome. This was awesome.
This has been awesome. Thank you
guys, that was a lot of fun,
Kevin.
And more than happy to do another show. We can do one on parking. I think that we could probably fill an hour just on parking. So,
and what is your podcast, by the way?
It's called Real Estate Investing for Cash Flow. I'm one of the old guys in the business. I've been doing almost 12 years now, which is interesting. Back before people knew what podcasts were, I used to have to tell people, they're like, where am I going to hear this? It's an internet radio show. That's what it is.
Where and what day of the week? When?
We release on Mondays.
Okay. I'll look for it.
Yeah.
That's awesome.
Thank you, Kevin.
Kevin, thank you.
Thank you,
Guys, it's
Humberto.
been a pleasure. Thank you.
And we'll get you back for parking. Bye.
Cheers, guys.